All right, let's work with some example problems from Chapter 6, or the chapter covering inventories and cost of sales. This chapter is looking at concepts related to how we account for inventory after we've recorded it and purchased it. One of the concepts that we have to look at is when we purchase inventory, what costs are included. And so this first problem is going to have us working with that. A car dealer acquires a used car for $14,000 with the terms FOB shipping point. We are going to compute the total inventory costs that we assign to the purchased car if additional costs to the purchase include the following. So in addition to paying $14,000 to buy the car, they paid $250 to transport the car in, shipping in, $300 for insurance while it was being shipped, $900 for car import duties, which is taxes, $150 for advertising, $1,250 for sales staff salaries, and $180 for trimming shrubs. The general rule when we buy inventory, any cost we incur to get the asset in place and ready for use are all costs of buying the inventory. They are all costs that we record as our asset. So when we're looking at all of these costs they've listed here, the only cost that we are going to include in the inventory when we record it into the accounting system is going to be costs related to the purchase and getting the inventory ready for use. Okay? So if a car dealer acquires this car, they're buying the car for $14,000. So that's going to be part of the cost we record in our inventory account. In addition to that, any costs we incur to get it to us and ready for use is also going to be part of the cost. So $250 to get it to us. Yep, part of the cost of buying it and getting it to us. Shipping insurance. Yep, that's also going to be part of the cost to get it to us. So we are going to add both of those to the inventory cost. Import. We're not going to get the car to us unless we pay those import taxes. So yes, that is going to be added to our cost. However, $150 for advertising, sales staff salaries, trimming of shrubs or landscaping costs, those have nothing to do with the inventory that we bought. Those are all operating expenses. So we do not include those in our inventory asset account. We would just record those as an expense. So the total inventory cost that we are assigning to that car will be the $15,450. Okay, those other three costs are not necessary to get the vehicle to us and ready for sale. Another concept related to inventory that we are buying is who includes inventory as part of their inventory when they're preparing their balance sheet. And the confusion becomes when inventory is like between the buyer and seller. Maybe somebody else has physical possession of some of our inventory. Okay, and so it really comes down to the rule, whoever owns it. Right? So whoever owns inventory includes it as their asset on their balance sheet, regardless of the location of the inventory. So for example, if at the end of the year, Bar Company had shipped $12,500 of merchandise inventory, FOB destination, to Lee Company, they're asking which company should include that inventory as part of its year-end inventory. And it comes down to who owns it. The shipping terms are key here. FOB destination means ownership transfers when the inventory arrives at its destination. That means that the seller has shipped it, but the seller still owns it while it is in transit. The buyer will not accept ownership until they physically receive it. So that means if Bar Company sent this inventory, but on the last day of the year, the last day of the accounting period, the inventory is still in transit, then the seller, Bar Company, would include that $12,500 of inventory as part of its year-end inventory. Okay? Because Bar retains ownership until it reaches the buyer. Along those same lines, what if Paris Company had shipped 20,000 of goods to Harlow? So Paris shipped the goods to Harlow. Harlow has arranged to sell the goods for Paris. So Paris sent some of their inventory to Harlow, but Harlow is not buying the inventory from Paris. What's happening here is Paris is consigning, physically handing their inventory to a seller. Paris is the consignor. They are assigning the inventory to Harlow, who is the consignee. They're physically possessing the inventory, but they do not own it. The consignor is the owner. They still own the inventory. Paris still owns the inventory, even though Harlow, the consignee, has physical possession. Who should include the unsold inventory as part of their inventory? Whoever owns it. Paris still owns the inventory. Paris will include it in their inventory, even though Harlow physically has custody of it. The owner is still Paris. Okay, so that first problem we did, what cost do we include in inventory? Any cost to buy that inventory and get it ready for sale. Who includes the inventory? Whoever owns it. All right, so now that we've looked at how to account for the cost of buying the inventory, getting it ready to sell, how to account for who owns the inventory so we know who's reporting it as their asset, let's talk about valuing that inventory. Hey, and at the end of every accounting period, generally accepted accounting principles want us to take a look at that amount we have recorded in our inventory account, and we need to reflect on, is this cost that we have in the inventory account, is that really reflective of the value of the inventory to us? And so what we have to do is we have to apply this rule called the lower of cost or market rule. Essentially what that means is generally accepted accounting principles want us to look at the cost, the amount we have recorded in the inventory asset account. Compare it to what its market value is, what its current sellable value is. When we compare what we paid for it, the cost, with what the market value is, what we could currently sell it for, generally accepted accounting principles say whichever is lower, the cost or the market of the inventory. The lower amount is the amount that you are going to report as your assets value on the balance sheet. It's very, very simple to apply. If we take a look at a physical inventory for Liverpool Company, physical inventory, they went in and counted all their inventory as of December 31st. They have 3 different categories of inventory. Within each category, they have specific inventory items. They physically counted how many of each inventory item they have. So these are the quantity of units. They looked at the cost that they recorded, the cost that they purchased each of these inventory items for. And then they also did a market evaluation to determine what they could sell, currently what the market's willing to pay for each of their inventory items. Applying the rule to compute the lower of cost or market, we're going to look at each inventory item separately. Very, very simple to apply. Over here you can see in my chart all of these items in these first 3 columns are all just given. This all comes straight from what we were provided in the problem. These next 2 columns have just done a little bit of math, extended some of these columns. This total cost column is multiplying the number of units of each inventory item times the cost, what we paid for those inventory items. So we have 345 speakers at a cost of $90. The total cost of our speakers inventory, $31,050. 260 stereos at a cost of $111. Total cost, $28,860. So all we've done here is multiplied the units times the cost to get the total cost for each inventory item. Then we did the same thing, multiplying the number of units times this market price, what we could sell this inventory for, to get the total market value of the inventory. Units times the market price per unit to get total market price. Okay. So these two columns are just doing math, extending out some of those amounts. Now to apply the rule, we are going to compare each inventory item's cost to its market. For speakers, total cost is $31,050, total market value $33,810. The lower amount is the cost. Because cost is below market, that's the amount that we're going to report for our speakers on our balance sheet. Stereos, the lower is the market, so we are going to use that number. Amplifiers, cost is lower, that's the amount we're going to use. Subwoofers, market is lower, that's the amount we're going to use. Alarms, market is lower. Locks, market is lower. Cameras, cost is lower. Tripods, cost is lower. Stabilizers, cost is lower. Cost is lower. So now that we have applied each inventory item, identified which is lower, cost or market, we have totaled up to get the lower of cost or market for our total inventory. So it's pretty easy to apply, as you can see. So what does it all mean? Well, essentially what this means is if we had not applied this rule, the cost of the inventory is the amount that we would have recorded in the inventory account when we bought it. But when we now have analyzed and evaluated the market, we realize that some of our inventory items, the value for what we can sell them has fallen below the cost. So if we were not to apply this rule, we would report an asset at a value of $292,777, which would mislead whoever's looking at our balance sheet, because really our inventory isn't worth that to us, because at the most we could sell right now is $273,054. Right, so this is really an example of conservatism in accounting. We would end up making an adjustment in the general ledger, which is beyond the scope of our course. We're not going to get into that. The only thing I really needed you to know is that this rule exists and how to apply it. Okay, and now that you know it exists, you can also see that applying it is really, really simple and straightforward. All right, so the first couple problems we're having us looking at how to account for inventory costs, as well as what inventory do we record. Then we kind of took a sidestep and went and looked at applying this lower of cost or market rule at the end of every accounting period to be conservative in how we report our inventory on the balance sheet. Now we're going to kind of go back and take a look at these cost flow methods. And essentially what these methods that we're about to look at in this problem do is they help us assign a cost to inventory when it's sold. It also helps us assign a value to our inventory at the end of each accounting period. So we're going to work with Warner Woods Company using a perpetual inventory system. It's giving us information about purchases and sales transactions for the month of March. They have given us some more information that we will need to use the specific identification method. It told us for the sale where those units were sold from. And here is the information, what they're starting with in inventory, units that they purchased, units that they sold. And what they're going to ask us to do is several things. The first couple things we're going to look at is figuring out what is the cost or the dollar value of the goods available for sale, as well as the physical units available for sale, and how many of those units remain in ending inventory. So what comprises the cost of the goods available for sale and the number of units? Well, if you stop and just think about logically, the number of units that they have available to sell is going to be a combination of the inventory that they start this year with, inventory that they already had on hand, plus all the inventory they bought during the year. Okay. So taking a look at our information, they started the year with 100 units at $50 a piece. So this is the inventory they had available to sell at the beginning of this year, or the beginning of the month. Then during the month of March, they made several purchases. On the 5th they purchased, on the 18th they purchased, and on the 25th. And what they paid for each of those units when they purchased. So if we add those 3 purchases to our beginning inventory amount, that's going to tell us the total number of units that they had available for sale, as well as the cost of the units available for sale, the cost of the goods available for sale. Now, if we know throughout the month of March they had 820 units available to sell, and they've asked us to compute how many of those units remain in ending inventory, the difference between what we had available to sell and the units that we sold is going to be the units we have remaining at the end of the month. We had 820 units available to sell. We sold 420 units and another 160 units, so we sold a total of 580 units. We were left with 240 units of inventory on hand. Why are we doing this? Why are we calculating this? Well, stop and think about this. We know we were recording things into our inventory account at their cost when they were purchased, right? So we know that the amount that got recorded into the inventory account is going to be $46,600. As we were selling the inventory, though, every time we made a sale, we have to assign a cost to the inventory that was sold. And we're not entirely sure where or which layer of inventory those units came from when we sold. We need to be able to figure out how to assign a cost to these 2 sales. Because this is what we sold them for. This was the selling price. We need to be able to determine the cost to assign to those units sold. Because remember, every time we make a sale, we have 2 journal entries to record. It's like on March 9th when we made the sale, we will record the revenue earned. We also need to assign a cost to the inventory sold. We need to do the same thing on March 29th. And what these methods that we're about to apply do is they give us a way to assign a cost to the inventory when it's sold. Okay, so let's try it. The methods that we're going to look at are the FIFO, the LIFO, the weighted average, and specific identification. We're going to start with the FIFO method. Okay, so we're using this information, and using our FIFO method, we're going to set up this chart for keeping us organized, right? This isn't a formal anything. This is just a way for us to stay organized. We are going to start March 1st with 100 units of inventory that had cost us $50 a piece, starting the month with $5,000 in inventory, given in the problem. Keeping things in order chronologically, the first thing that happened is on March 5th, we made a purchase. When we made that purchase on March 5th, we added to the inventory we already had on hand. We had the 100 at 50. Now we added another 400 at 55, increasing our inventory balance. On March 9th, we made a sale. When we make that sale, we have 2 journal entries to record. We need to record the revenue earned. That's easy. We record that at its selling price. We also need to record our cost of goods sold entry. Using the FIFO method, we are going to come up with an amount to assign to those units sold. On March 9th, when we made this sale, this was the inventory that we had on hand available to sell. We had 500 units available to sell. We sold 420. Using the FIFO approach, we are going to start with the first in inventory is the first out. Of the inventory on hand, the first in were these 100 at 50. We will assume they are the first out. So we will assign $50 to 100 units that we sold. We still need to assign a cost to another 320. So this layer is now wiped out. We will go to our next first in layer. We will assign $55 to the other 320 units sold. So the total cost I'm going to assign to my units sold is going to be $5,000 plus another $17,600. Total cost of goods sold that I'm going to assign is going to be $22,600. That is the amount that I will record up here in this journal entry. What does that leave me with in inventory? That leaves me with only 80 units at a cost of $55 a piece, or $4,400. These are all sold. 320 of these are sold, leaving me with 80 of those. Okay. On March 18th, we made another purchase. We added 120 at $60 a piece to our inventory. We still have the 80 at 55. We've now added 120 at 60, increasing our inventory balance. Next thing that happened chronologically, added another 200 unit purchase. So we still have these two layers of inventory. Now we've added a third layer. Okay, notice that I'm keeping these inventory layers in chronological order. Helps me stay organized. So that on March 29th, when I made a sale, and I'm recording my 2 journal entries, I know what to record my revenue, the selling price. I need to assign using FIFO, cost of goods sold. So on March 29th, when I sold 160 units, this is the inventory I had on hand at the time of the sale. First in, first out. The first layer in were the 80 at 55. 80 of the 160 sold will be assigned a cost of $55 a piece. That wipes out that layer. Go to the next first in layer using FIFO. I need another 80 cost. I will assign a cost of 60 to the other 80. That will bring my cost of goods sold for this sale to $9,200. That is the amount that I will record into my cost of goods sold entry. That leaves me with none of these guys, they're all sold. Of the 120 at 60, 80 are sold, leaving me with 40. And I still have all of these in inventory. So my total cost of goods sold for the month of March is $31,800. My ending inventory under the FIFO method at the end of March is $14,800. The key to applying these methods, stay organized. Keep everything in order, right? And use this little chart. It does help quite a bit. Now let's do the exact same thing, but let's use the LIFO method. LIFO is doing the exact same thing, but it assumes that the last inventory in is the first to go out. So on March 1st, again, we're starting with that same inventory. On the 5th, we added to that inventory. We now have 2 layers of inventory, keeping them in chronological order. On March 9th, when I make that sale, I'm going to record 2 journal entries. I'm going to record the revenue earned, and I'm going to use LIFO to assign a cost to the inventory sold. This was the inventory on hand when I made that sale on March 9th. I'm going to start with the last in layer. Last in is first out. Of the 420 that I sold, I'm going to assign a cost of $55 to 400. To get the cost for the remaining 20, I next need to go to the next last in layer. So I will assign a cost of 20 to the cost of 50 to the remaining 20 units. Total cost of goods sold for this sale is going to be $23,000. That is the amount that I will put into my second journal entry for this sale. That leaves me with inventory of 80 at 50 because all of these guys were sold, and of these 20 were sold, leaving me with 50, or an inventory balance of $4,000. March 18th, made a purchase, added to my inventory. So I now have 2 layers of inventory. On the 25th, I bought more inventory. Added to my 2 layers, now I have 3 layers of inventory, kept in chronological order of when we purchased. On March 29th, we made a sale. We are going to record 2 journal entries. Revenue earned at the selling price, we need to assign a cost to the inventory sold. Under the LIFO approach, this was the inventory on hand at the time of the sale. I sold 160 units. Under the LIFO approach, I start with the last in layer. Last in is first to go out. All 160 units sold will be assigned a cost of $62. That will leave me with 40 of them remaining. And I didn't touch my other 2 layers. They are still in inventory as well, leaving me with ending inventory of $13,680. My total cost of goods sold for the month of March, $32,920. We've looked at FIFO and LIFO. Now let's do the exact same thing using the weighted average method. What the weighted average method does is it says, when you sell inventory, assign whatever the average cost of the inventory is. Okay? So again, using our same data, starting off with our beginning inventory, on the 5th of March, we made a purchase. When we make this purchase, it's going to affect the average cost of our inventory. We started the month with an average cost of each inventory item of $50. To get the average, I take the total dollar amount of the inventory, which is $5,000, divide by the number of units in inventory. On average, the cost of each inventory item is $50. But on March 5th, when I added another layer of inventory, my total cost changed. So my new inventory cost of $27,000 divided by my new number of units, divide by 500 units. My new average cost of each inventory item on hand is now $54. What that means is on March 9th, when I sold 420 units and I'm trying to assign a cost to the inventory sold, the weighted average method says use whatever the average cost is at the time of the sale. When we made the sale, the average cost is $54 per unit. So I will assign $54 to the inventory sold, or a cost of goods sold of $22,680. That's the amount I will record in my cost of goods sold journal entry. That will leave me with 80 units. I had 500, I sold 420. 80 units at an average cost of 54 or an inventory balance of 4320. On March 18th, I made another purchase. Whenever I make a purchase, it is going to affect the average cost of my inventory on hand. When I made that purchase, my inventory went from 4320, increased to 11,520. My new number of units is 200 units. So 11,520 total inventory cost divided by 200 units. My new average is 5760 per unit. When I made another purchase, it's going to affect my average again. So on the 25th, I added 12,400 to my inventory, bringing my total inventory up to 23,920. Increasing my units from 200 up to 400. So my new inventory cost divided by my new number of units, I have a new average cost per inventory item of $59.80. So that on March 29th, when I sold 160 units, using the weighted average method, I am going to assign the average cost of $59.80 to the units sold. So I will record a cost of goods sold in my entry of $95.68. Total cost of goods sold for March using this method is going to be $32,248. My ending inventory under this method is $14,352. All right, so we have looked at FIFO, LIFO weighted average. The last one is specific identification. This method is pretty straightforward when we are told what unit is sold, right? So they told us that for the units sold, 80 units came from the beginning inventory, 340 units from the March 5th, 40 units from the March 18th, 120 units from the March 25th. So we were able to specifically identify what inventory items were sold from each layer. This was the inventory on hand, 80 of those were sold. This was the inventory that we had purchased, 340 units of those were sold. 40 units were sold from this purchase of inventory. 120 units were sold from the March 25th purchase. Okay. So if I add up all of these, that's my total cost of goods sold for the month of March. This is my ending inventory under specific identification. Okay. So the last thing this problem is asking us, compute the gross profit for each company using those 4 costing methods. Okay. Remember, cost of goods sold is subtracted from our revenues to get our gross profit. Okay. Notice that in these examples, the total revenues earned is exactly the same no matter which of these methods we use. Because remember, these methods do not affect the revenues. Okay? The revenues are the same regardless of which method we use to assign a cost. So the revenues for every single one of these is for the month of March is going to be the 35,700 plus the 15,200 or 50,900. What does change is the amount we've recorded for the cost of goods sold. Under FIFO, for the month of March, we calculated a cost of goods sold of 31,800. For LIFO, we calculated a cost of goods sold of 32,920. For weighted average, we assigned a cost of 32,248, and specific identification, a cost of 32,540. Those are the amounts that we have listed here. The gross profit is a little bit different under each of these methods, right? And the reason the gross profit is different is because each of these methods comes up with a slightly different amount that we assign to the inventory as it's sold. All right, hopefully this helps with the application of this concept.